Today's lesson objective is to understand the impact of indirect taxes on consumers, producers, and the government. So, what are indirect taxes? An indirect tax is a tax on expenditure. Here are two examples of indirect taxes. One is value-added tax, which we also call it as VAT, and the second one, excise duties. And the impact of these taxes would differ, but today's lesson we're going to look into an ordinary impact that's going to take place in the demand and the supply curve. As you can observe in this diagram, there is a demand curve and a supply curve. Equilibrium price is at 10, whereas the equilibrium quantity is at 50. If the government introduces an indirect tax, what would be the impact? In this case, there isn't any impact in the demand curve, but there would be an impact in the supply, whereby the supply will reduce, shifting it towards the left side. Now let's see how is the impact going to be. As you can observe here, the supply curve shifts to the left. Therefore, the new equilibrium price will be the purple dotted line, which is 12, whereas the new equilibrium quantity, 40 units. When there is an increase in indirect tax, it pushes the supply curve to the left, thereby increasing the price from 10 to 12 and reducing the quantity supply from 50 to 40. Now, let's show the tax incident in this particular diagram. As you can see here, we already identified the new equilibrium price 12. Now look into the purple dotted line where it intersects with the original supply curve. Therefore, it's intersecting at a price of 8. Now let's see how to show the tax incidence in consumers as well as the producers. Remember, to show the tax incidence in a demand and supply curve, the consumer tax burden will be shown on the top, whereas the producer tax burden on the bottom. Therefore, the yellow highlighted area represents consumer tax burden, whereas the green highlighted area represents the producer tax burden. Now let's have a look at this in detail. Right, so I'm going to use the same diagram for further explanation of the same elements which is shown in this diagram. First step is to identify the original price and the quantity. Therefore, you can see OG is the original price or 0G and 0B is the original quantity. Now let's look at the new equilibrium price after the impact of a tax. Now your quantity reduces from B to A, therefore your quantity is 0A whereas your price increases from 0G to 0F. Therefore, the new equilibrium price is 0F. Moving to question C. Incidence of tax per unit on consumers. Remember, when we talk about tax per unit, look into the changes in the price. So as you can see in the diagram over here, the prices are H, G and F. Keeping this in mind, incidence of tax per unit on consumers is the area of G and F, whereas incidence of tax per unit on producers H and G. Tax per unit in equilibrium would be H and F. Now, let's identify the tax which is paid by the consumers, producers, and the tax revenue for the government. This is the key lesson objective for today's lesson. Look at the rectangles. Total tax paid by consumers. You can see the yellow color-coded area represents consumer tax burden. G, K, E, F represents consumer tax burden. Whereas total tax paid by the producers is a green highlighted area. G, H, J, K represents the total tax paid by the producers. So what is the total tax revenue for the government? It's a combination of consumer tax burden and the producer tax burden. Therefore, F, H, J, E represents the total tax revenue of the government. Now, let's find the change in producer revenue. Now, when a tax is introduced, producer's revenue would definitely drop. Initially, the producer revenue was at 0, B, C, G. Due to the impact of taxation, now the revenue will only be 0, A, J and H. Now let's look into the changes in consumer expenditure. When a tax is introduced, it would definitely push up the prices of goods and services. Therefore, the consumers would definitely reduce their expense. The original consumer expenditure was at 0, B, C, G, and now the consumer's expenditure is at 0, A, E, F. Hope you had a clear idea of how the tax burden has an impact on the consumers, producers, and the entire government. So the government revenue would be FEJH, a combination of consumer tax burden and producer tax burden.